And like I said, when I had that moment on the beach, I decided from here on the rest of my life, I don't do things I don't love. I just refuse to do things I don't. I literally decided, like, I had a moment when I was camping on the beach and I said, if I have a choice between doing something I don't want to do or homeless, I'll be homeless.
Hello, everyone. I'm happy to introduce you today a special guest, Bobby Casey. He's an entrepreneur, investor, and the founder of the Business Anywhere, a platform that helps to manage U.S. companies remotely. He is also services as a managing partner at Global Wealth Protection, focusing on asset protection, tax strategy, and a global business structuring for entrepreneurs and investors. Bobby, welcome. I'm happy to have you on my podcast. And please take a stage.
Sure. Hi, Stella. Thanks for having me today. Sorry about the little mix-up getting started, but I think we're all good now. I hope you're having an amazing day.
Yes,
So, thanks for inviting me.
my pleasure.
Oh.
Bobby, you know what? Let me start from that question that actually I wanted to know myself.
Sure.
How did you get into the global business and asset protection? What led you to focus on helping real estate investors? Let's start from the beginning of your journey.
Sure. So, I I was raised in an entrepreneurial family, so I've been an entrepreneur my whole life. I've had multiple businesses over the years. I've actually never had a real job. I've never had a professional job. Just I started working when I was 12 years old. My first official job, I was 14, and just kid jobs until I was 19. And then I started my own company. But growing up, I was raised in an entrepreneurial family. So for me, it wasn't, I never had the mindset like, hey, let's get this good grades so you can go to a good college and get a good job and have this good corporate job. That was never me. Never anything that happened in my
So
like
you grew up
growing
already.
up.
You grew up in that environment from that child.
Yeah. My grandpa, actually, he retired before I was born, but my grandpa had a chain of restaurants with my uncle, like long before I was born. He was already retired, but then the mindset's still there. And then my dad had a construction company and a real estate development company. And so for me, it was even as a kid sitting around the dinner table when I was 12 years old, 13 years old, we were talking business stuff like company structure and tax strategy and investments and like how to read financial statements and that sort of thing. Like my dad taught me how to read financial statements as a kid.
Wow.
A little bit, and a lot of it was self-taught. I started reading a lot of investment books and personal development books in my teen years and early 20s. So like for me, business was just life. So anyway, I had a business that did pretty well. I started in my 20s, 2020 or 21 or something like that. And it did really well. It grew pretty well. I was a service company in the US. And during that time, I had bought some of my competitors, kind of rolled them into one company. I had also had some other things. I did some real estate investing. I actually bought and sold a restaurant during that time and during my like mid late 20s. And at that time, I realized like for me, I maybe had some liability exposure. So asset protection was really something I had thought about it. When you're an entrepreneur, all you really care about is the next sale, the next
Right.
job, the next deal, the next hire, the next
You always look
partnership.
at next, right?
Yeah, always looking at the next thing. And so you forget about the things like bookkeeping and legal structure and tax filings and asset protection planning and stuff like that. So I got to a point where I had enough assets where I thought I should really do something about this. Did a little research. I ended up hiring a guy like me. Ironically, his name was also Bob, but I hired a guy like me in my 20s, like late 20s, I guess. I think I was 26 or 7 or something like that. And I hired a guy like me to help me with my structure. And I became really fascinated with the process of asset protection planning and structuring and that sort of thing. And at that time, or I say at that time, but actually still now, all of my friends are entrepreneurs. I don't really have friends with jobs. Like I just don't know anybody that,
Surround yourself with the people like-minded.
yeah, I really only have entrepreneur friends. And so at that time it was the same. And so I went to the guy that I hired, Bob. I said, look, I got a bunch of friends that are also entrepreneurs that could benefit from the same structuring we did for me. How about we work together? I bring them on. You train me a little bit. We do some consulting with them. And like, because to me, it was fascinating. It's like solving a puzzle.
Right.
There's so many minor details that you have to factor in. And to me, it was like building a puzzle. And it was so cool to do this asset protection planning and structuring and tax optimization and stuff. Over the next couple of years, it was just, let's call it like a side gig, a hobby business for me to do that with some people I knew. And then a few years later, I ended up selling my other businesses, and I had a life-changing couple of moments, and I decided I wanted to change some things in my life. And one of the things I decided was I really wanted to do a different business. And so my other businesses, I didn't really like them. Actually, to be perfectly clear and transparent, I hated them. I hated the businesses. I hated my customers. I hated my employees.
You had to go through that hating.
Yeah, I just really came to the point where I hated all of it. So I ended up selling everything. I sold like all my real estate. I sold the restaurant. I sold the other business, and just, there was a couple other, I actually had a moment where I almost died. I had a motorcycle crash and I was in the hospital, like in a coma for a week and stuff like that. And so I woke up and I'm like, life is too short to not enjoy what you're doing. So let's make some changes.
Absolutely.
And I ended up, I had a RV, a motorhome. I had an RV at the time, and I took a 1-week trip to the beach, and I was camping on the beach by myself. I went completely alone.
Wow.
And I just went and I said, I'm going to sit here and reflect on things and plan and figure this out in a week.
Amazing.
So I did that. I literally camped on the beach. I went and filled up my refrigerator in the RV. I never left the campground for a week. I stayed there completely alone, just with me and my thoughts. I didn't even have a TV in my RV. Nothing of nothing, just me and the sand and the sea, and just sitting there reflecting and journaling and everything. And I realized the consulting thing I had been doing with my, let's call him my mentor, Bob, I really enjoyed it. I loved it. I loved the process of problem solving. And so I decided I'm going to formalize this into a business. And that's what I did. Starting in 2009, I officially started Global Wealth Protection. I'd been doing that for several years, but officially, let's say, started it in 2009. And then I was traveling a lot. I was always traveling a lot. It's just, for me, it's a way of life. And when I sold the other businesses, I lost my location anchor. And I was married at the time, 3 kids. I still have the kids. I don't have the wife. So I was married at the time, and we moved to Europe, sold the business, moved to Europe. And I just said, I enjoy this life. It's adventurous. It's fun living in different countries and stuff like that. That put me in a different circle of people with more location independent entrepreneurs. And so I really started focusing on dealing with that, let's say, demographic of people, because I enjoyed it. And like I said, when I had that moment on the beach, I decided from here on, the rest of my life, I don't do things I don't love. I just refuse to do things I don't. I literally decided, like, I had a moment when I was camping on the beach and I said, if I have a choice between doing something I don't want to do or homeless, I'll be homeless.
Wow.
I will not do something I don't want to do. Like, I just absolutely refuse to live that way. And for me, the way I live, it's always forward. There's no way
back. You always have to be moving forward.
There's no back. Like, for me, when I take a step forward, it's like taking the hand grenade, pulling the pin, and I blew up the bridge.
That's what people do. They have no choice, and that's the only way. I blew up the bridge.
Always. I'm pull the pin, throw the grenade. I blow up the bridge. I move forward. Like I don't
Wow. I love
ever
your
look
story.
back.
Wow. It's amazing. And you know what? Sometimes just being alone with no distractions, especially on the beach and next to the nature, that's when all the thoughts are coming. There's no distraction, there's no people around you. I love it. Sometimes I do that. I go away for a couple of days and trying to think what's the next step and
I
to
do this.
my goals,
I
especially when I
usually I do this at least once or twice a year now, where I'll just completely go away and not talk to anyone. So usually I travel somewhere. I usually go like earlier this year. What did I do? I went, to be honest, I forgot where I travel so much. I
probably travel
forgot.
so much, so even for you, even forgot about which
Like,
places.
like last year I went to Portugal for a week. Like I went to Lisbon and rented like a really nice penthouse
Right,
apartment with a
right.
beautiful view of the sea. And I just camped out for a week in Portugal.
Nice.
I don't remember where I went this year though. I'm
You when
drawing
you
a
remember,
blank.
you will share with us. Traveling is amazing as well. But let's get to our topic for our audience, which is always I have my investors, they do some mistakes. And I know when you have these big deals and all that, what's the biggest mistakes that you see that real estate investors do? And especially, what's the right way to structure the deal? What would
Sure.
you advise them?
So I just real quick, I want to clarify one point. You are talking about real estate investing in the US, right?
Correct. Yes.
Okay. Yeah. Because the laws and regulations are different in every country and you have different
Well,
rules and
we
regulations.
can touch on a little bit on other parts of.
I've been a real estate investor in the US and a few other countries for a long time.
Okay.
So I'm familiar with a lot of different jurisdictions in that regard. And also I had a lot of I have clients in, at this point, probably over 100 countries. In my work, I have to research the different topics and different
Okay.
geographies and stuff like that. But so we'll talk specifically for the purpose. I just want to clarify. So we'll talk about the US real estate investing. There's a lot of mistakes. And I say this coming from a personal perspective too,
Okay.
because I've made a lot of mistakes in real estate investing myself. But aside from the normal things like making sure you do the math on the deal, like real estate investing in general, this is my view. This is how I look at it. So take that with a grain of salt. Maybe it's a different perspective. But when it comes to real estate investing, you make money on the front end. You don't make money on the back end.
Mm.
And what I mean by that is, let's say you want to buy, we'll just keep it simple, like a single family home, a rental house. And let's say, to make the math simple, let's say this particular house has a rental income of $1,000 a month, like gross projected rent of
Uh-huh.
about $1,000 a month. So that's basically potential rent of $12,000 a year. And if that house cost $100,000, 12,000 divided by 100 is a 12% cap rate,
Right.
right? Whereas if that house was $200,000, that's a 6% cap rate.
Right.
So what I mean by that, and obviously this is a simplistic example, but buying the house at 200,000 is not a good deal. Like a 6% cap rate on a single family home is a terrible investment.
Right.
In my opinion, a 6% cap rate is absolutely terrible because cap rate is not real numbers anyway, right? Cap rate is just a tool you use to measure something, just a metric, but it's not the money you make. You don't make 6%.
Correct.
Probably making around 3% cap rate and
After all the
3% net.
expenses and all that. Yes.
Yeah. Yeah. You've got a broken pipe, a broken HVAC. You got to put a new roof on. You've got vacancies for 2 months, those
Right.
types of things. And I think a lot of times new investors don't do good math on the front end. Like they see, okay, I can buy this house and I can get a mortgage and the mortgage is $850 a month and I get $1,000 a month of rent. So I'm going to make $150 a month.
Mhm.
No, absolutely not. You're losing money in that scenario. You're 100% losing money if you collect $1,000 in rent and your mortgage is $850. And so I think a lot of times real estate investors, they just don't do good math. And so
Well,
learning the math, I think, is really important. Learning how to properly analyze a real estate deal. Like for me, a very simple metric is I won't even dig deeper on a investment, like real estate investment. I won't even go beyond surface level if the cap rate's on at least 10%, like
I see.
full stop. I won't even consider it because that means most likely my best case scenario is I'll earn about 5%, 5 or 6.
Right.
Like kind of the rule of thumb is your net yield is about half your cap rate. And so maybe if you're really good, you get 6.5%.
Right.
But
Bobby,
yeah,
but
sure.
right, it's all about the numbers in commercial real estate or investing. The cap rate and the numbers, that's the first thing that you should look at in order for you to make sure that you're making the right deal. You're right.
Yeah.
But there's any other obstacles or any other that we should point to
Sure.
investors to be more giving
Sure.
that attention to them?
Yep. So getting your numbers right in the beginning, critically important. You don't even go to step 2 until you understand actually how to analyze a deal from the financial perspective.
Right.
And again, I just want to stress, like I see way too many people that don't do the math right on the front end. They
Right.
just don't get it right. And then 5 years later, they're like, oh my God, I'm losing so much money every month, but I've got a tenant. Why am I losing money? Anyway, like that's a normal thing. I think also, and by the way, I say that not picking on anybody or giving anybody a hard time because I've done that. Like I bought some rental houses in my early 20s and I had these glorious visions of getting rich quick on real estate. And I would buy some rental houses and have $100 in net cash flow above my mortgage and think, this is going to be amazing. No, it's not. It sucks. It really doesn't. You gotta have your math right. And that's what I mean. You make money on the front end, not the back end. One more point on that.
Sometimes I see that if the rates are low, if the cap rate is low, if you have some room at value, meaning that we can add some value and pick up the rate, there's some options as well, right? Or
Sure.
feel that
Yeah. So let's say you're looking at an apartment building, for example, with let's say 20 units in it. And
right,
let's say you're analyzing this deal and all of those units, maybe you've had the same owner owning that building for 20 years and they just weren't good at raising rental rates in the unit.
right,
They just, people get like that. They're like, oh, I don't feel good about raising rent this year. Let's keep it down. They get
Yeah.
this emotional attachment to tenants and they don't understand sometimes investment. You've got to treat everything like a business when it comes to this. So if you need to
Right.
raise rents, like you got to raise rents, like it's just reality. Or maybe they had bad contracts, rental contracts. They didn't have step up in rent each year and those types of things. But sometimes you get a building like that and you'll say, okay, everybody's paying sub-market rents, maybe 30% below market rate rents. And I can come in and buy this building, do a little renovation, bump the rents up over a year or two,
Right.
and then I get my cap rate up. Sure, there's always examples where that can
example
happen.
actually I had, which investor was trying to buy and the cap rate was low. So what he did, he updated the laundry room. He actually provided the parking, which is additional value. So you probably have to see if you have that room to add value. This way we can create more cash flow
Sure.
as well.
Yeah.
So there's
Right.
it depends on the deals as well.
Like laundry rate, if you start charging a reasonable rate to do laundry, hey, there's another cash flow stream. You put a
Right.
coffee machine, you put some coffee machine or a coffee kiosk in there, a little more cash flow. You start charging you start charging for parking. You can add some extra value. Maybe somebody wasn't charging for parking before.
Right.
Sure, there's always things you can do there. I guess my example was pretty simplified just for
Just
the
have to
sake
be
of
more
math.
creative about that extra value thing.
Sure.
I
Yeah,
like
there
that.
is things to add. Yeah.
I like the way you actually put in the structure, which is numbers and it's the first thing. And then if you can add value, we can add value.
Yeah, you can absolutely, very often you can add value. There was somewhere else I was going to go with that too. Yeah, interest rates play a big deal. And I look at investments too from a comparative analysis. So let's just, for math's sake, let's say this building has a 10% cap rate. So I'm probably going to get around a 5 or 6% net. Oh, I know where I was going with this. I'll
Okay.
probably get about a 5 or a 6% net yield on cash flow.
Okay.
And when I say you make money up front, I mean, you buy the deal right in the beginning, it has the proper cash flow and the right deal from the beginning. But a lot of people also, the other mistake a lot of people make, and I don't know how long you've been investing, but if you recall back in 2008-9, when we had the big real estate
I've been
crash,
there. Oh my God, that was the
it was a
biggest
mess.
peak of the short sales and foreclosures and all that. But it was a different market. It was different.
It was a mess. It was a disaster. But what a lot of that, not all of it, there was obviously some banking shenanigans happened there too, but a lot of investors were getting excited on the hype of investing in real estate. And so they would buy property, not making money on the front end, meaning not doing the math correctly on the front end with
Right.
the hope that, hey, this property is going to go up in value 10% a year, and I'll sell this thing in 5 or 10 years. And even though I make zero cash flow for the next 5 or 10 years, I'm going to have capital gains at the end. And to me, making a real estate deal with the hope of capital gains in the future, how can I say this kindly? It's really stupid. It's really, really terrible idea to make a real estate deal with the hope of future capital gains. To me, the future capital gains is icing on the cake.
Okay.
That is, I don't plan for it because maybe it doesn't happen. Like right
But
now,
it worked before. It worked in 2008. I see.
until it didn't. Yeah, until
Right.
it didn't work, right?
Yeah, everything has their own timing.
And
Now it's a different market. It's a different.
And that's part of the reason we were in that mess in 2008, because people were buying houses in 2000 and 2002 and 4 and 6, and they were buying houses. They would get a rental house that, for math's sake, it's $100,000 rental house with a $900 mortgage and an $800 rent. And they would say, oh, I can lose $100 a month. It's fine because it's going to go up in value over the next few years. And their math included a future capital gain, but I can't predict the future no more
It's
than you can or
unpredictable,
anyone
right?
else.
You're right.
So that's why I say you have to make money when you do the deal in the beginning, not at the end, hoping for capital gain. If you make money in the beginning and the house never goes up in value, you still make money.
Right.
If you make money in the beginning and the house goes up in value and you sell it and you get a capital gain, that's the icing on the cake.
Right. That's
my
a great
opinion.
advice. That's a great advice, especially right now in that timing. I would like my listeners to put this in the.
Yeah.
I like that.
And there's a lot of other things. Like I'm sure you probably look at this, and maybe a lot of your listeners do too. But everything investing is data driven. You have to look at things like interest rates, housing starts, available housing, any shortages in the housing market. If you're in the housing market, if you're in the commercial real estate market, you got to look at the same data, but those data points, like for office space or retail or whatever you're looking for, like
Demographics or
demographics.
Right.
Take a market like Charlotte, North Carolina, or Atlanta, Georgia. These are both growing residential markets. There's a lot of people moving to these because they have big companies there, home base there, lower cost of living, lots of jobs. These are good markets for basically everything. But you take some market like, I don't know, middle of nowhere, Iowa, where nobody's moving to, that's, from a demographic perspective, it's not that you can't make money in that market.
Yeah, it's not that.
But it's not an active market. You don't have a lot of people coming into town, which means you don't have much commercial activity. You don't have much residential activity. You just have to look at demographics. But anyway,
You're right.
That's the math side. You asked a little bit about the structure and legal issues, I think is where you were going. The other big mistakes I see, especially with new investors, but I'll be honest, I've seen this happen a lot with experienced investors, and I've even seen this a lot with real estate attorneys, is doing the wrong structure for your real estate holdings. Oh my God. I have countless stories with mistakes there.
Wow.
If you want, I can give you a couple of case studies.
Yeah,
maybe
you
if
can give
that's
me like
helpful.
a short case. This way we know exactly what we're talking about.
So I'll give you two case studies. One, I had a client. This was not my BusinessAnywhere client. This is my global wealth protection client for asset protection. had a client in Texas, Dallas, Texas, a few years ago. He had 10 rental houses, and he had got some advice from somebody that it was a waste of money to own all of his properties in LLCs. He was told that's a waste of money. It's a waste of time. All you need is property insurance and then like an umbrella policy and you'll be fine. Like it'll protect you from everything. It's such a, like to have 10 LLCs for each house or even one LLC that owns all 10.
By the
Somebody
way,
told him it was a
I
terrible
wanted to
idea.
ask you about this topic and you're telling me this story. I just had that question from my investor. Stella, should I do the LLC or should I do a reply on the insurance? What kind of pros and what kind of cons we have? So I would love to hear that from you. This is actually an
Sure.
amazing topic.
So first of all, I want to stress that I do think if you're a real estate investor, you should have insurance on your properties. 100% you should have insurance because once you sign that contract with a tenant, whether it's a commercial property, single family home, multifamily, retail, it doesn't matter. Once you sign that contract, you have no idea who walks in the door of that property.
Right.
You have no clue. You can't be there every day looking at every human being that walks in the door. You don't know. You could do a background, like single family home. You could do a background check and it could be the most beautiful, nicest family you've ever seen. 3 years later, the teenage boy decides he's a delinquent, has a party at the house. All his buddies are doing drugs.
Right.
Somebody gets drunk, drives home, gets killed. There's a fight. Like you don't know. You never know what's going to happen. And if you're the owner of that house, you become the, as they say, the deep pockets. You're the one that's going to be personally liable for those things. And so relying on only insurance is a dangerous thing. And the reason being, have you ever had to make an insurance claim, like for anything, like a homeowner's claim, a car insurance claim, anything? And if you remember what happens, you have an insurance adjuster that comes out and they have a really nice smile and they're really friendly and they hand you their business card and they're like, hey, I'm here to help. I'm here to make sure we get this sorted out for you.
Yeah.
But in reality, the entire job of an insurance adjuster is to find a way to not pay you.
Absolutely right.
That's their entire job. It is very much it's a conflict of interest. You and that adjuster have two completely different goals. Your goal is to get paid out on the claim because you bought insurance. Their goal is to find some loophole to not pay you. Right. And nobody ever reads it, but every insurance contract on earth has about 700 pages of fine print, right? And no one ever reads it, ever. No one ever reads it. But every one of those lines of fine print is a loophole for them to not pay you.
Wow.
And so my case study, the guy in Dallas had 10 rental houses. He owned all of them in his own name, and he had liability insurance on the properties. The problem was one of the tenants decided they were going to be very entrepreneurial.
Okay.
And by entrepreneurial, I mean they had a meth lab in the kitchen of the house.
Wow.
And the house went kaboom. There was a fire. Some people got hurt. I think this has been like 5 years ago. So I may miss some of the details, but I'm pretty sure somebody got killed. Wow. I don't know if you've ever seen a meth explosion, at least maybe in the movies or something, but they're not pretty.
It's huge.
It's not like a little grease fire because the grease dripped off the side of the pan making bacon. It is a kaboom kind of thing. And yeah, he had this massive lawsuit from the injuries or possibly a death. And they went after him. Guess what insurance does not cover? They do not cover illegal activity. So that was this insurance company's loophole to not pay the claim is because guess what? Selling meth is illegal in Dallas.
Wow.
So they didn't pay the insurance claim, and this guy lost all 10 of his rental houses.
Wow.
All 10. Because there was a multi-million-dollar lawsuit because of the injuries and I think the death, but it was a multi-million-dollar lawsuit. And the guy ended up, and because he personally owned the houses, well, the injured party sued the owner of that one house. That guy owned 10 houses. And so they sued him and they basically foreclosed on all of his properties. And that's the asset they used to satisfy the judgment. Now, is that a normal situation? No, of course not. It's an anomaly, right? But guess what? It only takes one anomaly to bankrupt you, like to make you completely broke. Man, I have so many crazy stories like this. I had one story. It was a lawyer who came to me. He's in South Carolina, Columbia, I think. I think he's in Columbia, South Carolina. And he was the general counsel for basically a commercial real estate company. And this company, they did a lot of they had a lot of commercial buildings. I'm talking like anchor shopping centers, like with Target as the shopping center or Kroger supermarket or something like that. Like these are big shopping centers.
Okay.
And they had a lot of them. And this blew me away because I thought this was just like, how does this real estate attorney like screw this up so badly? But he was general counsel for this company, and we had some mutual friends, and one of his mutual friends said, hey, you should probably call Bobby and talk to him about the structure because something doesn't seem quite right. Now, I want to share this. This guy was a lawyer for 20 years. He was not like fresh out of college or anything like that. He was general counsel for a big real estate investment company. So he should know better, but they don't always know better. So what they did is each one of those properties were owned by a separate LLC, which that was good. Okay.
Right.
That part's good. However, they did two really big mistakes.
Like
the first one is, and I'm assuming, Stella, at some point you've registered an LLC somewhere in some state.
Right. Yes.
And so, when you go, if you've ever done it yourself, or if you hired somebody to do it for you, you've still seen the articles of organization that you file when you register the LLC. When you go through that file or that form to do the filing with the Secretary of State, there's two sections on there. There's one that is the registered agent section. So you have to name a registered agent and the registered address, because with an LLC in the U.S., actually, this is the same all over the world. But if you register an LLC in the U.S. in any state, you have to have a registered, like a legal address or a registered address for the company in that state. So a registered agent serves the purpose of being the legal address for the company. That way, they are the legal point of contact for anything that happens with that entity. So a registered agent's role is to be available during working hours, Monday through Friday, to receive notices like from the IRS or the Secretary of State or the Department of Revenue, or what's called SOP mail or service of process mail. That's the mail where you have to have a human sign for it. So legally, that's what a registered agent does. That's their role.
I see.
And they decided they didn't want to spend $100 or $200 a year for all these LLCs. So they used the principal owner of the company. They used his home address and his name as the registered agent for, I don't remember, man, it was like a couple of dozen LLCs, South Carolina LLCs. So they used his personal name and his home address. And then also there is another section in most states, not all of them have this, but most states have another section where you fill in the information for organizer. And so organizer is the person that's actually filling in the form.
Right.
And they use his name and his address also as organizer.
Wow.
Now, you may think, or maybe some of your listeners think, what's the problem with that? I don't want to pay the $100 or $200 a year for a registered agent either. The big problem with that is you just expose your personal information in public record and there's no way to eliminate that document from public record. Like the first LLC that was formed in the U.S. was in Wyoming in 1977. You can log in right now to the Wyoming Secretary of State website and look at the original articles of organization filed for the very first LLC in 1977. It's still there. Every LLC that has ever been formed in all 50 states and the territories, that information is public record forever. So if there can be nefarious intent there, like with exposing your home, like your home address and your personal information associated with that property. Right. Nefarious intent, like somebody stalking you, somebody stalking your spouse, somebody stalking your kids. or somebody has like ill will towards you for some reason. And they're
Right.
like, hey, I think Stella owns this shopping center. Hey, let's go look in public record. Aha, here's the LLC that owns this property. Let's look on the Secretary of State's website. Aha, here's Stella's name and here's her address.
Looks like
Let's
you
go to,
yourself. You
yeah.
think protecting of LLC, but from another point of view, you expose.
So yes, that's a good point. You think you're protecting yourself by putting it into an LLC, but just forming an LLC is not a bulletproof strategy. You have to form it in the correct way to have full protection. And there's a lot of things that go in there, like commingling funds and stuff like that. But anyway, this is the big mistake they made because they exposed him in public record, and
Right.
it made it easy for them to find the ultimate owner of the property. So if ever and what frequently happens in a lawsuit against real estate, actually all lawsuits, not only against real estate, but any lawsuit, generally what happens, you've got the claimant's attorney. They say, hey, we'll pick on you for a minute, Stella. You got a claimant's attorney that wants to go sue Stella. And they say, let me go see what Stella owns. So they do like a public record search and they find, aha, looks like Stella owns this LLC because, hey, she's the registered agent. Look, here's her home address. Hey,
Right.
she's the organizer of the LLC. We can find all these things. So instead of when they sue the business, they'll sue you personally also. That's very common. But if they can't prove, like, for example, let's say that shopping center, if there was some incident at the shopping center and they needed to sue the owner of the shopping center for
Right.
some negligent event or whatever,
Okay.
if they don't find his name in public record, they sue only the LLC because that's all they can find. And then the process server goes to the registered agent and the registered agent signs for it. Okay. So they don't show up at your house or your
Right.
office. But if you use yourself as the registered agent, they add you to the lawsuit and then they come knocking on your door at dinner time. The process server comes knocks on your door at dinner time.
So you see,
So
not
that's
everyone knows that kind of ways to do the right
no
way.
one knows it. No one thinks about it. Also, if you ever go on Reddit, we do a lot of Reddit marketing for BusinessAnywhere. We have a team that answers questions on Reddit, and we literally answer this question 10 times a day. Our marketing team answers at least 10 times a day on Reddit because people say exactly that. I don't need an LLC for my real estate. It's a waste of time and money. Or the other thing is, hey, I'll just register my own LLC and save the $100 or $200 a year for registered agent fees. And that is a massive mistake. That is the number one biggest mistake I see people make when it comes to the structure of their entity is if they do have an LLC is they do it themselves because they want to save them $200 a year, something like that. The other mistake this guy made, the real estate attorney from the firm, they had all these LLCs. I don't remember, dozens. They had a lot of shopping centers around South Carolina. And they had one holding company that owned all of the LLCs. And generally, I'm not opposed to holding companies. I think they're a good idea, except their holding company was a C corporation.
Okay.
You never want a corporation to be your holding company, like ever. Because from an asset protection standpoint, let's say I'm suing you. Let's say I'm suing you, Stella, and I do a record search and find out, hey, something happened at one of your properties. Okay, I'm going to sue the property. Oh, I see this property is owned by an LLC. Okay, we're going to sue the LLC. But the LLC is owned by a holding company. Let's go up the chain to the holding company. If the holding company is a corporation, a C corporation.
C corporation. Okay.
It can be an S corporation too. S corporation holding company is just as bad because it's still a corporation with shares.
Wow.
I'll take a little sidebar here. S corporation is a tax election, not an entity type. S corporation. So there's no such entity called a C corporation. There is a corporation and you can have C corp tax election or an S corp tax election. But there's no entity type called an S corp or a C corp. There's just corporation.
Right.
You can also have S corp and C corp tax election for an LLC too, by the way. So the entity structure is what I'm talking about. So having a corporation own like all of these LLCs down here, the problem is if I sue you personally and your assets are in a corporation, the court can take shares of your corporation and
Right.
give to me to satisfy the judgment. Whereas if your assets were in an LLC, it's much more difficult, if not impossible, depending on the state the LLC's in. It's much more difficult or impossible to take any interest in the LLC because they're treated differently than a corporation.
Mhm.
So from an asset protection standpoint, if you have a C corporation, like for an operating business, let's say, or an S corporation, it doesn't matter. But if you have a corporation and you want a holding company, you want the shares of that corporation to be owned by an LLC because that protects you and your business from your personal action. So when it comes to liability, you've got two different types of liabilities. You have inside creditor liability and outside creditor liability.
Okay.
Inside is something arising from the activity with the business. So like in real estate, a slip and fall incident, somebody
Right.
blows up the house with a meth lab, something like that. That's an inside creditor liability because it happens
Inside.
with the activity of the entity itself. But an
Right.
outside creditor liability is like somebody sues you personally for something.
Right.
Let's say, I'm guessing, Stella, you're Russian, so you probably get in a lot of fights at bars, right? So imagine, Stella, you go to a bar, you get in a fight, you beat this girl up and you break her jaw,
Okay.
right? And she sues you personally, right? She comes after you personally because you broke her jaw and she sues you for $1 million, right?
Okay.
You Russians, you guys are tough. I get it. My ex-wife was Russian. I know what it's all about.
Uh-oh.
So
I see where you're coming from.
yeah, same. Trust me. So if you personally get sued for that action, they're going to sue you and come after your personal assets.
I
If
see.
your personal assets are in a corporation, they can take shares of your corporation to satisfy the judgment. But if
Wow.
your assets personally are in an LLC, it's very difficult, if not impossible, for them to go after those assets in the LLC itself.
I see.
So you have two sides to an asset protection situation. Like most people think everything's in an LLC or a corporation. I'm fine, but they forget about the other side of it, like the personal side. And obviously that's just a funny example, like a silly, funny example, but it could be a car crash. Like you run a stoplight and crash into somebody and you kill somebody and it goes beyond your car insurance limits. So it could be that something happens. There's a million different things that can happen. You have a Super Bowl party at your house. Somebody drives home drunk and kills somebody.
Yeah,
They
like
sue
I
you
said,
for that.
you always wanted to be protected with the
Yep.
right protection.
Yep.
Which is important advice, especially for today's topic. And I want you, Bobby, to give them advice how they can protect and how investors can scale their and protect their wealth. I think these two things, protect their wealth and how to scale, that we wanted to cover as well.
Sure. Yeah. When it comes to wealth, right? The wealth formula is really simple.
Mm.
It's how much money you make,
Right.
subtract how much money you spend, equals savings. Savings times your investment rate. That's the wealth formula. It's pretty simple, right?
Right. Okay.
So this piece over here, your invested piece, right? Every piece of this becomes a critical thing. How much money you make. Obviously, you want to make more money, right?
Right.
The money you make really, maybe this is more of a philosophical viewpoint in a sense, but to me, the amount of money you make is directly related to the impact you have on the world. If you have a big impact on the world, you're probably going to make more money because you're reaching and touching more people in a valuable way.
Right.
So the money you make depends on the value you provide to the world, whether it's through your business, your investments, how you leverage your investments to create more housing or more retail space or whatever for your marketplace, whatever it is you're doing, minus your expenses, right? And
Okay.
like you can go back and read some of these old like books like The Millionaire Next Door, where they talk about don't buy Starbucks every day and you'll become a millionaire. There's some truth to that. No one's ever become fabulously wealthy by not drinking Starbucks, but there is some truth to controlling your expenses because that's the wealth formula. Income minus expenses is your savings. The bigger your pile of savings, the more you can invest, right? And then from a liability protection standpoint and an asset protection standpoint, that investment, whether it's your business, your real estate, your stock portfolio, your crypto holdings, whatever,
Right.
putting barriers or shields around that with an asset protection strategy keeps what I call the predators away. Predators being like litigation, you've got
Right.
frivolous litigation, slip and fall, like
Right.
kind of events
Definitely.
with your properties. You've got class action lawyers where there's an entire industry out there trying to take your money. You've got like personal injury lawyers out there, have an entire industry trying to chase you for all kinds of things. But the better you build this asset protection strategy around your wealth, the more money you keep, right?
Okay.
And it's always easier to keep your money than it is to make more, right? So the lower you can get your tax rate down and take advantage of different tax optimization strategies, and the better you can protect your wealth against predators like litigation and stuff like that. That's how you grow your wealth. That's how you build an empire. That's how you build a legacy. Right?
Beautiful. Beautiful. Amazing information. And Bobby, I got so much value from you. And it's just we have to do it much often. I feel that you have so much to share. And as everyone, Bobby helps entrepreneurs, investors to structure and protect and scale their business globally. And I feel that the value that you can give to our audience, it's priceless.
I
I'm
appreciate
so
that. Thank you.
happy to do this with you. We actually went above the time, but it's always pleasure to hear everything what you have to share with us. And hopefully we can do that much often and have you on my podcast much often as well. So it was pleasure having you. If you have some final advice or final words, you're more than welcome to share.
Sure. Yeah. If you're looking to reach out to us, like I have two websites, my two main companies. I have a third company that I won't mention, but .com, that's the website where we do consulting and tax strategy and asset protection planning and that sort of thing. The other company, it's BusinessAnywhere.io. We are basically an online platform for registering your company, registered agent service, virtual mailbox, remote online notary. We have a lot of tools in there. You can open your bank account straight in our dashboard, bookkeeping, tax filings, trademark filings.
Business Anywhere, that's a great platform. I had the chance to use it and it's a great idea. And I see what you're doing with that. You're growing every time and trying to improve with all other tools. Amazing.
Yeah, we're adding new features like every month, and it's a full compliance pack. I will mention one more thing about it because this is significant to real estate investors, especially those that have multiple entities.
Right.
Our platform is the only one that fully automates your state compliance. If you have LLCs, you've probably seen this, and especially if you have multiple LLCs, you've seen this in the past. You get the notice from the Secretary of State, hey, you need to do your annual report filing, click here to pay the fee, click here to file your annual report, click here to pay your registered agent service, stuff like that. Our platform, our software, we developed this actually, it was like a spinoff of Global Wealth Protection because we registered a lot of entities for our clients. And to be honest, purely out of laziness, I hired a software developer to automate all the state compliance for our clients. And it works. So we just spun it off as a separate company. So Business Anywhere fully automates your state compliance. So you get if you register an LLC with us next year, you get a notice saying your LLC is up for renewal. If you want to renew it, you can just ignore the email and our software automatically completes your annual report. It pays your state fees. It renews your registered agent service. You don't have to touch anything.
Wow.
And what I've heard from real estate investors is that's extremely attractive because especially ones who have multiple entities, like we have a lot of clients that have 20, 30, 40 LLCs. And they say like a lot of them already have the LLCs. They moved them over to us because they got tired of late fees and reinstatement fees because they miss an email or they miss a notice.
It's a lifesaver. It's a time saver, lifesaver, meaning that you can do everything at that platform.
Yeah. Like some states, like Florida, for example, like the fee to file your annual report's like about $140, I think. But if you're late, it's a $400 late fee.
Wow.
So like Delaware, it's if you're late, like the franchise tax is $300. They don't really have a annual report filing. It's a franchise tax, but it's $300. If you're 1 day late in Delaware, it's a $200 fee. And so like a lot of our clients, like real estate clients that move their LLC stuff, they're like, oh my God, this is so good because we don't have to think about renewals anymore.
Amazing, Bobby. It was a pleasure having you.
Thanks for having me.
We will do that again. Okay?
Perfect. Отлично. До свидания.
Bye-bye. Thanks. Thank you for listening to the Stella Top Seller podcast. If building real wealth through real estate is your goal, this is your show. Subscribe and follow me on social media. I'm Stella Shalamova. Keep thinking bigger, investing smarter, and living the top seller mindset. Until next time.